let's go ahead and get started. All right, so a little bit about me. Real estate is my second career, and got into real estate back in 2017 after retiring from the NFL. And my red pill moment really was when I got injured and I had to retire, and I really wanted to retain the same lifestyle that I had in the NFL through real estate. And I found that cash flow was the key to financial independence because I knew that I did not want to work for anyone. I recently went full-time in real estate as of April after working for a couple of real estate, private equity and institutional firms, and decided that this was the route to financial freedom. So my background is in asset management for retail and institutional private equity firms. And as of now, I'm an active sponsor in multifamily syndication deals in Baltimore City. And we currently focus on value-add and opportunistic commercial real estate assets and deals. So my goal today is to really help create a train of thought to step into the game actively or passively. And I think this webinar today would, allow people to create that thought to get into the game. So, all right. So how do syndications work, right? Obviously, it's if you're not familiar with the syndication, basically you raise the capital to go out and buy deals, right? And there are a lot of complex moving parts within the syndication space, and it's a high learning curve as well. And how you deal with that really is by a lot of different things, right? You either leverage other people's track record. You can, find a team to surround yourself with, but really it's a high learning curve. And dealing with syndications, there's a greater element to risk because now you're dealing with SEC rules and guidelines. And if you mess up, the SEC will come after you. So a little bit about how syndications work, right? So an overview of a syndication structure is you start with your limited partners, right? And these are the partners, including the sponsors as well, because if you're a sponsor and you're investing, you would be in this bucket, right? So your limited partners are the ones who provide the equity for the project. They're passive. They participate in the cash flow, the appreciation within the equity, the tax benefits as well, and everything that has to do with the investment. The thing with the passive side is the primary risk on your deal is only your capital, because you're 9 times out of 10 not signing for the loan. And the ones who are actually sponsoring the deals, the GPs, are the ones who are assuming all the risk on the project. And that can be personally as well. So in the limited partnership bucket, you are only limited to your capital. And then on the other side, it's the general partnership side, right? And so you have the active investors like myself who are out there finding deals, underwriting deals, negotiating, submitting offers, performing the due diligence, negotiating offers, structuring the best financing, which is super, super critical in today's environment, guaranteeing the loans, structuring the partnership, overseeing the property management company, asset management, construction management, everything from start to close. Basically, your sponsors or your general partners are responsible. So in this case, when you become an active investor, you have unlimited liability, because when you raise funds under SEC guidelines, they do not play around when it comes to anything negative within a project. So definitely have to understand like who you're partnering up with as well, because one bad apple can definitely spoil the entire bunch. So what's a typical structure, right? We just talked about structures. We talked about what's an overview of a syndication, but what is a typical structure, right? So you have a sample entity structure here. Now you have the holding company that goes out and actually buys the property, right? This is the holding company that is actually going to own the asset. So it might be 123 Main Street LLC that will hold title to the property. And then within that entity, you have Class A investors who are the limited partners or the passive investors on a project. And then on the other side, you have the Class B members who are the sponsors, right? The folks who are the lead sponsors, finding the deal, analyzing the deal, doing the risk capital, the due diligence, and asset management and disposition, right? So a typical structure might be a 70-30 split, 80-20 split. In some cases, maybe a 90-10 or 60-40. It all really depends on how the deal works for the investors. Because when we look at deals, our investors to us are like clients, right? And so we're going out there trying to find them good projects that we can distribute cash flow on and also provide the tax benefits. So we want to make sure that, maybe sometimes we might throw in a preferred return, right? So what that means is the first maybe 7% or so, if there's a 7% preferred return, the first 7% of all the cash flows would go to the investors. And then after that hurdle, right, it's split 70-30 between the investors and the sponsors or the managers of the project. So this is like a typical structure. And this is something that, most, sponsors and operators do, is this similar structure because it's nice and clean and easy. All right. So now you know a structure, you know about syndications on a 30,000 square foot level. Like, how do you develop a team as an active investor? And one of the things that I noticed from working for different private equity firms and also doing things in my own business is that you really go as far in this game as the good team that you have. So what I mean is that without a good team in real estate private equity, it's very, very difficult to scale on a large level, right? So you really need to know like who exactly you need on your team, because there are a lot of different buckets that contribute to your overall ability to close the deal, right? So how do you develop your team as an active investor? Well, think of it like an all-star team, right? When I look at people who we want to hire, whether it's, on a payroll perspective or on a consulting perspective or just 1099, I'm looking for all-stars, right? I need to know, can you get the job done? That's all I really care about. I don't really care what you look like. When I look for people, I need people who are excellent in what they do. So how do you develop your all-star team, right? Well, the first thing is you really need to figure out who's going to actually mentor you through this entire process, or just even to get your first deal done. Because there are things that you're going to run into that you're going to have to ask questions about, and mistakes that you don't want to make, because we're not dealing with single family homes where the loan amount is like 50,000 or 200,000. We have multiple $1 million loans on properties. And so it's crucial that you really know someone that can actually kind of guide you through the process. Second crucial part to this entire all-star team is your equity investors. You're only really as good as the amount of money that you're able to raise in real estate, right? If you want to do single family, you can probably get by with doing your own deals, raising private capital. But to do larger real estate deals, 50, 100, 200 unit deals, you really need to have equity investors. So that's super crucial when you're thinking about building your all-star team. Your property manager, that's probably the number one reason why most people are successful in real estate private equity, is the fact that they have people who act on their behalf and follow exactly how they want the property to be operated, and then also executed, right? Because that's how we make our money. So a property manager is really, really crucial, because it can literally drive your investment to the dirt, which ultimately impacts your investors, and you do not want to have that reputation. Your real estate brokers, right? So one of the things that is really important, so a lot of times when I talk to real estate brokers, like, I'm always trying to build a connection, right? And it's not necessarily like just talking about business. I try to build a deep connection, because people do deals with people who they like, know, and trust. Like I just got a deal in my inbox about 10 minutes ago from a property that just, the last buyer didn't close. And because we've transacted with this broker a couple of times, I'm the first person that he's, he likely reached out to, because he knows that I'm in that area. Right. So the two things that really drive a private equity business is your deals and your money. If you can't find any deals, your investors can't park their capital. If you can't find any capital, you can't close on deals. So I would say the two most important things in real estate private equity is either deals or money. The next person is a mortgage broker, right? And we always have a Rolodex of different mortgage brokers that we have within our Rolodex, because your lender is always going to be your biggest partner for the most part, right? If unless you're buying properties all cash, we have a Rolodex of different lenders, and we know exactly what their criteria is, and we stay in touch with them because we want to know when we're penciling a deal, when we're underwriting a deal, we need to make sure that we're underwriting, especially in a competitive market, we're underwriting as close as possible based off of what the lender is going to be looking at. Your real estate attorney, super crucial here as well. Typically in the syndication space, your real estate attorney needs to be licensed in the state that you're doing the actual transaction in. But sometimes real estate attorneys have different partners that they could partner up with if they're not licensed in a specific state. So if I'm looking at a deal in Atlanta, my Maryland attorney may know someone that they could partner up with and they can get this deal done. So SEC attorneys, super crucial here. I'm happy to recommend any SEC attorneys that you guys may be looking for. This SEC attorney is licensed to practice, all over the country. But when they file their certain forms, they have to file it in the state that some of your investors may be in. So SEC attorneys can obviously help you as well, because they can also save you money whenever you're putting these documents together. Typically, these documents cost a minimum $7,500 to $9,000, depending on the transaction, and that was probably the low amount. So your SEC attorney, super crucial when you're putting these deals together. Contractors, we talk about value add. I mentioned that, our strategy is a value add strategy. And I'm sure that we have a lot of real estate investors in the room today. This is probably one of the most challenging parts of our business, because we're always managing people. But contractors, what I've found is as you scale up into larger deals, you get more professional representation. So the smaller deals, you maybe can't hire, a large contracting firm. But with the smaller deals, you probably might have to hire someone a little bit smaller. The challenge is with the smaller guy, you may not have the capacity from him to do a lot of units on your renovations, right? The larger folks, they have the capacity, but they come with a price. So definitely take a look at that whenever you're putting your team together, and match that up with the property. Insurance brokers, super important here. Definitely have to make sure that you're putting the right insurance on your property. One insurance that I think a lot of people skip over is ordinance of law, right? So basically what that is that if you're buying an older building, and let's say the building went on fire, and let's say the entire building went into flames, right? It's not really repairable. You probably have to build up, whatever the case may be. If you have ordinance of law coverage, basically what that means is that they would cover the cost to bring it up to code. So little things like that, definitely got to make sure that your insurance broker is super sharp when it comes to putting the right property coverage on your property. And then the last thing, tax professionals and cost segregation. We, as a real estate investor, full-time real estate investor, we get to qualify for something called a real estate professional tax status. And what that allows me to do is that it allows me to take all of the depreciation that we get from apartments, all of our rental portfolio, and directly cut our tax bill. Now, I'm not a tax attorney or anything like that. Definitely talk to your tax professional. But this is really how I've seen a lot of real estate investors make a ton of money in this space, is because they, quite frankly, don't pay taxes. So definitely have to have your tax professional. All right, so evaluating deals as a passive investor, right? We talked about the active side. Let's talk about the passive side. And what I think, if I was a passive investor today, given all the volatility in the market, I want to make sure that I have a framework to perform the due diligence. Because if I'm looking at a whole bunch of deals and, different deals, it might be multifamily, self-storage. At the end of the day, a due diligence process always has some sort of borderline framework, right? And then your number one thing as a passive investor that you always want to be wary of is, how am I going to get my capital back? That's your biggest priority, is return of capital. And so definitely I'm going to break down a quick framework for you to perform due diligence on any deal that you come across. This is a baseline framework for you to perform due diligence. So evaluating passive real estate deals, right? Do your due diligence. The first thing that you absolutely want to look for is sponsor experience. I think a lot of people kind of overlook this, and it's easy with like Instagram and different social media platforms for people to post pretty pictures, and you might think, hey, wait, this person is like super super successful and super, you know, he seems like he knows what he's talking about. But a lot of times there's a lot of pretend experience in the real estate space. And so what I like to do is when I'm having conversations with different sponsors, whether it's on the active side, you know, I try to get into the weeds to kind of see who's doing what, right? Because if you are just maybe capital raising and joining different opportunities, you know, that's one thing. But if you're an operator that knows the weeds, that knows how to hire people, that knows how to deal with troubling problems, things like that, you know, I want to make sure that I'm investing with someone that knows the business very, very deeply, has a lot of depth within their knowledge. So sponsor experience, really important here. The second thing is business plan risk. And in this volatile market, I think this is specifically in my space too, right? The multifamily space. I think this is the most important, one of the most important things that you really need to look at is business plan risk, because we're living in a time where the capital markets or interest rates are just fluctuating. You know, back in March, the Fed funds rate, you know, was relatively very low compared to where it is right now, right? It's just out of control. And things are changing very, very quick. And so business plan execution and risk is very, very important, I think, in today's market, because I don't think that we're going to have so much of the tailwinds that we've seen over the past couple of years, right? And I think in this particular real estate cycle, you're going to have to rely on a lot of the fundamentals and not just rely on 10, 20% rent growth to make the best returns on your property. The third thing is financial risk, right? I mentioned, you know, return of capital. You know, are you going to get your capital back when you invest in this project? You know, what's your financial risk? That is something I'm always looking at within any investment opportunity. And you definitely want to make sure that you're protecting your capital. We're talking about asset risk, right? Different assets are riskier today than ever, right? We talk about office, right? If we talk about office, you know, this office market is really, really just detrimental right now. I mean, if you guys are in DC right now, the DC office market is brutal. And I've been hearing a lot of people turning in the keys because they can't afford their loan payments. And so asset risk is really important. A lot of times what I like to do is I like to go on different publications and look up maybe on Yardi.com, Yardi Matrix, and different publications to really get a sense of like what people are talking about from a risk perspective. Market analysis, right? You know, how are you evaluating the market that you're investing in? You know, you definitely don't want to necessarily invest in a market where rent growth is declining astronomically, right? Always want to invest in markets that have some sort of growth fundamentals behind it, or definitely have some sort of you know, job growth coming in, or something that would support a healthy market. And location analysis too. I think markets and locations are different from how I look at it. When I think about location, I might think about you know, if a property is located in a transit oriented development, right? But within that particular development or within that particular location, that might be located in a market like, let's say, for example, Baltimore City. Well, you know, not all places of Baltimore City might be good investments, but this specific location works. So really getting down to the nitty gritty of, you know, how you're evaluating these deals, I think this is a great framework for you to really make sure that you're investing your capital the right way, which ultimately should be preservation of capital at the end of the day. So we're concluding the end of the webinar. I mentioned that we're going to do a short one, so 20 to 25 minutes. I do have a bonus for a multifamily due diligence checklist This is the same checklist that we use within our acquisition criteria. I'm going to drop it in the chat. And, you know, this is something that you can use when you're looking at different deals, when you're looking at passive investments, to figure out that the operator, you know, if the operator is sharp and he's doing all the things that he needs to do to protect their capital. And I think this is a really, really good comprehensive guide. All right. So any questions? Thanks again for folks for jumping into the webinar. We had a huge sign on. I guess some people might be asleep tonight or just wanted to kind of, you know, take it in early. But here's a QR. If you're looking for any investment opportunities, just scan it to join our investment list. And I'm happy to transition into the Q&A section. If anyone has any questions that they have about, you know, real estate or real estate investment, feel free to you know, take off your mute button and ask a question, but it's more so an open concept of a Q&A, if any.
Hey, Yannick, it's Andre here. Appreciate you holding this webinar. A question I have for you is related to the type of investors you typically work with. Are they typically accredited or non-accredited? Can you share a little bit about that?
Yeah, so typically it's both, more non-accredited than accredited at this time. And so if anyone doesn't know what accredited and non-accredited investors are, so an accredited investor is someone that, for the most part, the baseline test is if you have at least $1 million in net worth, not including your personal residence or your primary residence, or you've made $200,000 if you're single, or $300,000 if you're married, filing jointly in the past year, and you expect to make the same in the next year, right? And so the non-accredited investor is someone who is just a sophisticated investor, right? And that's something that the SEC has guidelines around. But to answer your questions, we do both. We invest with accredited and non-accredited investors. All right. Do we have any other questions available?
I can keep going. But I'll let Melanie go ahead. I want to hog it.
No, sorry. I was just going to say, I don't see the link, Yannick, to the package you were going to.
Yeah. I'm going to post that link. This is what you're referencing right here. Let's see what's it.
Hey, Yannick, we had a question here on this side.
Yeah.
You can hear us clearly?
Yep.
Yeah. So I was just curious how the breakdown works between using the investor money versus the bank's loan. Like, how's that split? Like, how does that work?
Okay.
So it's not the LPs versus the GPs, but like the difference between you getting a loan and like I guess the LP's capital. Like, what is that breakdown? Like,
So typically the capital stack would be, let's say it's maybe 75% loan to value on maybe a $10 million deal, just for good numbers. That $2.5 million would be the down payment. And then we would have closing costs. And then we'd also have any sort of capital reserves that we want, any repair reserves, and then your construction budget. So let's say that total amount might be, call it $3.5 million. You know, an active investor would go out and raise that $3.5 million, and that entire capital amount would be the funds that would be used to close on the property, and then also be used in the bank accounts to administer any capital plans that we plan to do on the property. Does that answer your question?
Yeah, could we do it from the top again? You said it on a $10 million property. Is that what you said?
Yep. So
Okay.
how it goes is that if you, let's say you're buying a $10 million property and the leverage or the loan amount is 75% loan to value, right? So
Okay.
the lender is willing to give you a $7.5 million loan.
Okay.
So that $2.5 million difference would be the down payment. Then you would also need to have equity for the closing costs, and then any operational reserves, and then also maybe repair reserves as well, depending on if you have any, repairs that need to be done on the project. And then also your CapEx budget as well, right? So if you plan to renovate, let's say 50 units, right, you need to have money set aside to renovate those units, which will ultimately increase the rents, which will ultimately increase the equity within the project. So that 2.5 million plus all of those costs, an active investor would need to raise all of that capital to close on the property and then also have the funds to renovate as well.
All right, got it. Yeah, I understand now. Also, I have another question. Well, what's going to be your bread and butter like going forward? Like, what asset class? I know you, I know you're not going to do office, but like, what are you looking towards now? Like, what are you looking to kind of make your thing? If that's even on the table, like, do you have something that's your bread and butter right now?
Yeah. So our bread and butter is apartments. We're working on a couple of deals, 16 unit deal, that hopefully we're willing to acquire at 166 unit deal. So, we have a few deals in the pipeline. I think, for any active investor, I think how I look at the multifamily space today or just housing in general, I like to say, affordability is the biggest amenity. I think if you're able to just put clean, nice apartments on the market today, given the fact that we're in an affordable housing crisis, rents have rose, not really commensurate at all with, where how far wages have risen as well, right? And so there's a gap between what's on the market and then what someone can afford. So it's my thesis that I think as of the pandemic, I think that barrier to what we call like delinquency, right? What a property, what tenants own a property. I think that barrier has increased because not only have we had rents increase astronomically since the pandemic started, but wages haven't met that increase. And so that threshold below where you meet that affordable line versus underneath where you're probably going to see a lot of delinquency because people just can't afford those rents. I think if you're able to attract tenants who are just looking for nice, affordable housing, because they are not able to buy a single family home and because they're not able to participate in those markets, they're almost forced to rent. So if you can find that nice sweet spot where you're providing good, stable, affordable housing, and then you're attracting the tenant base that can actually afford that in those properties, I think that's a huge runway for multifamily today. So that's kind of like our bread and butter. And then we've also been looking at development opportunities for some larger yields as well. So.
Okay, cool. Yeah, that sounds good. Always good to have a rinse and repeat type of thing going. Yeah, this is my thought. Yeah, that's really good.
Yeah, definitely. Yeah, I totally agree. So, and thank you for your question.
Yannick, follow-up question to the last question. You started to address it a bit. Can you talk a little bit more about your current pipeline, your deal pipeline, as well as your previous track record as a syndicator?
Yep. So our current pipeline, I would probably say we have about 200 units in our pipeline. And as far as track record, most of the deals that we've done is in Baltimore City. So to date, we've done 2 syndications between a 22 unit and an 18 unit deal. And my partner is, more experience than I have. And so what we're doing right now is just focusing on the fundamentals within the real estate projects that we acquire. Because what I think is that I think the fact that capital markets are volatile, debt is always going to be your biggest risk on a real estate deal. And so if we're able to acquire a property with strong fundamentals, that's going to help us last through this interest rate environment. And so once we're able to refinance out of that project, because we've invested in a deal with strong fundamentals and we're not We don't have to sell. You know, the market's going to play out how we think it's going to play out. And because there's so much demand on the back end, I think withstanding those you know, the turmoils and things that you're dealing with in today's environment, you're going to be great in the long term and things. So I hope that answered your question. I know I went off with, you know, kind of how we see the market as well, but I hope that that answered your question.
It certainly did. Thanks.
How are you currently financing your deals? Are you doing like agency debt or?
So not agency right now, because typically they want some sort of prepayment penalty
Mhm.
or yield maintenance. And you know what we're looking at right now is bank debt, because what we're seeing is that we get the most if you're not in the multifamily space. Like if you cannot, it seems like for the most part, a lot of these deals are trading on the market with some sort of loan assumption,
Mhm.
unless the seller has to go out and then reprice it because he thought that he was going to get a significant amount for his
Yeah, I
property.
agree. I'm seeing a lot of loan assumption deals as well.
Yeah. So what we've been looking at is, although we don't want to take any recourse on the property as managers
Mhm.
of the project, bank loans typically you can negotiate some sort of interest only period. And a lot of times you can get out of those deals within 2 to 3 years or even throughout the entire loan term without any prepayment penalty. So what that allows us to do is that would allow us to, you know, tack on maybe some interest only to help us go through the value add program, ease up on the debt that we have to pay throughout maybe 2 to 3 years. And then once the capital markets, I think, you know, calm down within the next 12 to 24 months, then we can get out of those deals and get into an agency deal that we can, you know, capitalize on the lower interest rate in much better terms than we would get with a bank loan as well. And then also reduced recourse as well to non-recourse.
Got
So
it.
I think, you know, definitely getting into deals where your debt is very, very strategic, I think is crucial right now, because things are changing daily as we speak. So definitely that is something that you want to pay attention to. So thank you for your question.
Got it. Good analysis.
All right. Any more questions about anything that I talked about today?
And then you said most of your deals are in what, Virginia market or?
Yeah, so right now in Baltimore City, and you know,
Mhm.
our goal was to scale vertically. And the challenge is that a lot of times, well, let me say this, the challenge is that we're not seeing the deal flow that we want to see in Baltimore City from a larger scale perspective. And so what we're doing is we're reclassifying like how we're looking at markets. We're reclassifying the types of markets that we really want to be in, because some of those larger deals are trading in those markets. So for example, I see a lot of deals in Texas all the time trading, right? For, you know, 100 unit properties, 200, 300 unit properties. You don't see a lot of those traded in Baltimore City, or a lot of times just in Maryland in general. And so we're kind of seeing a lot of deals on like the 20 to 50 unit space, but we're not seeing that 50 to 100 unit space within the affordable housing, call it space, right? Because that's what we're investing in. And so right now our target market is you know, we've been in Baltimore City, but we're expanding into surrounding markets like Virginia and Philadelphia as well, where we can find some good yield.
Got it.
All right. Any other questions? All right, guys. Well, thank you so much for taking the time out to be on this webinar, and very excited to be back again. We're going to have another one in 2 weeks, and we'll announce the discussion. But if you guys listen to any podcasts, I do have a podcast called the Mogul Marathon Real Estate Podcast. And I created the podcast because I wanted to share real insights and real information to help people become a real estate mogul. So we talk about nothing but the real on the podcast, and everything that I've, posted on the podcast has been real experience and real insights. So definitely follow the show, and thanks again for tuning in tonight.